Hey, this is Lyle. This is part two. We're talking to Duncan Boyles from Texas Independent Insurance. Today, we're talking specifically for real estate investors. So if you're a real estate investor like me, if you're out there putting your money into work for you, he's got a kind of an interesting concept that we're going to talk about. Now, it is life insurance. You may have heard the spiels before, but the way he phrases it, the way he talks about it's a little bit different. If you haven't heard about it, stay tuned because there's some really cool stuff here. So Duncan, tell us what infinite banking is in a nutshell.
Right. So infinite banking is really it's the idea that money, no matter where it is, when it is, there's always a cost, right? It's an opportunity cost. So the whole idea of if you have your money out there, it's working against you. If you have, even if you have it and you have it underneath your pillow, it's still working against you because it's not earning interest. And so the idea that a bank is constantly earning or losing interest for you is really the premise of it, is that you always want to have your money working for you. And so that's kind of the premise of it. And then when you think about the mindset, and we've talked about real estate investors, right? It's, you want your money to be properly taxed. You want your money to constantly appreciate, and that's why they go into real estate, because it's a finite asset. So over the long term, it's going to appreciate, and then you want it to be able to cash flow. And so kind of having that mindset, life insurance goes right in line. And what's great about it is it can be leveraged. So when you have cash value, and the important thing with life insurance, a lot of people are like, oh, life insurance, it's got this bad name. These guys, they just, there's a bunch of commissions paid up front and it doesn't earn any money and all of that. It's low interest. All of that, may be true, but one, it's got to be structured correctly. So that's important. But secondly, it can be leveraged and it can be a significant tool, because the whole idea of infinite banking is having your money work for you in two different ways. So if you're a business owner or a real estate investor, and most real estate investors are both, you've got money as you're funding your life insurance policy. A lot of people use 401ks or, self-directed IRAs, which I think is great, especially if they've come from corporate world and utilize it. The thing is, when you pull money outside of that IRA or that 401k, you've actually moved the money out, right? And so let's say I have $100,000 in a 401k policy and I pull out $50,000 to use for real estate. Now I have $50,000 working for me here, and then I have $50,000 working for me here. So you still have $100,000 working for you. Just one is, hopefully in the real estate is getting you a very high rate of return.
Right.
Well, in the life space, let's use that same scenario. You've got $100,000 over here, right? And when I borrow, again, I'm not taking out, I'm borrowing against my policy. Now I have $100,000 still working for me over here, and I have $50,000 working for me here. And so now, not having $100,000 working, I have $150,000 working for me. And then, so that's kind of the premise of it. And what a lot of people like about having the life insurance is, one, you don't have the ups and downs of the market. And so you have reduced the risk of where your money is. And so if you think about putting your money in the bank, it's your money is relatively protected, right? Because it's government backed and all of that. And so you're like, okay, good. My money's not going to lose value in there. Well, that's the idea on the life side, is that, hey, you've got your money over here getting you either, kind of depending on how you structure it, you can get a guaranteed 3% return, or you can have a 0% floor, but with the upside potential. But the point is, you don't lose money. And then you can leverage it whenever you need it. And then you just use yourself as a bank. You use yourself as the bank. You pay yourself back. And now you've got money working for you constantly. You don't have to worry about going to a bank or anything like that. So that's the premise of it. Yeah.
Now, I know a little bit more than some people, but explain to us, there's different types of life insurance. So first, cover the different types and what you're talking about. And then I want you to go in a little more detail on that 150. If I have $100,000, how am I making $150,000 work for me?
Okay.
So explain those two concepts real quick.
Yeah. So traditional infinite banking concept, if you talk to people who are basically read the book Become Your Own Banker by Nelson Nash, he's kind of the godfather or the grandfather of the infinite banking. He's the one who started that. He is a whole life person. And what a whole life. So you have basically three types of life insurance, or let's even back up from there. You basically have two types. You've got term or temporary, and then you have permanent, right? Term meaning there is no cash value growth, and so term will definitely not work with what we're talking about. And it's really there for that legacy, right? So if I die, I have a family of 4. If I die, is my family going to be taken care of? Or now does my wife have to not only mourn me, she's got to try and fund and replace my income, right? And so hopefully she mourns me. But anyway, so that's term or temporary insurance. Usually they come in 10, 15, 20, and 30-year terms. Now you go to the permanent side. Permanent meaning it will last until you die. There is no end date. And it's also, it grows and it accumulates cash value, especially if it's structured properly. Now within the permanent side, there's whole life insurance where you have, it is, I would call it a little more stringent. It doesn't have the flexibility of payment schedule. I mean, you set up a contract and you have to make those payments however long you set up the contract for. And they can vary on how long you pay into it. And so that's whole life. They tend to be guaranteed. So they have, if you think of a ceiling and a floor, they have a very, their floor is 3%, right? So most of them are somewhere 2, 3, 4% is the guaranteed interest rate that's going to be paid into your cash value, or the money that the cash value that is going to be earned annually. And then they have dividends. In most cases, they're going to pay out a dividend depending on the performance. So that's whole life. Okay. Then you have universal life. And then you have indexed universal life, because universal life, if you have variable, it can go up and down with the market. Mm-hmm. Indexed universal life is basically an index, or it's indexed off of, it can be the S&P 500. There's a few different ones that you can index off, but we like to use the S&P because that's one, it has the truest representation of where the economy is. Right. So when the market goes up, your account is going to be credited up to a ceiling. 10%, 9.75, 12, depending on the company, right? There's a cap. But then there's also a floor of 0%. And so if the market goes down, think of 2008, right, where it dropped 37%, or 2020, right, when it's dropped and it's been really volatile, you're going to be protected against that downside. But then when the market goes up, you're going to capitalize on that gain. So those are the two types that we do from an infinite banking perspective. We do both. I do both. I prefer, personally, I like the index universal life because it has a greater potential to grow, and it will provide you more passive income, or has the potential, let me rephrase that, has the potential to provide you more passive income later on in life. Mm-hmm. So,
okay. Yeah. And now tell us how that works with if I have $100,000, I can now leverage 150. How that works.
So the idea of it is, right, I mean, everybody understands the concept of leverage. It's really, leverage is a term, kind of a positive spin to debt, right? Mm-hmm. So, but I mean, the whole idea of leverage is it allows you to do more. If you leverage, think of the pulleys, right? I mean, we created pulleys so that we could lift greater weight than what we can do personally. So having that lever, having that pulley allows us to lift more weight by using that leverage. So the idea of leverage, and the idea of taking $100,000 and having 150 work for you, the concept is, again, kind of using the 401k, where if you have 100,000, let's say you have $100,000 over here, right? And you need to use 50, you got to take 50 out. Mm-hmm. So now I have 50 and 50. Yes, so there's your 100. There's your 100. So you have 50 here and 50 here. Life insurance with the right company. Again, you have to be with the right company. Right. But the idea on life is you have $100,000 here, let's say, and I want to use 50 of it. I just borrow it like I'm borrowing from a bank. Okay. And so I borrow, and I'm using 50 over here, but my 100,000 is still working for me. So let's say, let's use 2008 or 2009. That was a good year, right? It was a rebound year. So one, I didn't lose any money the previous year, and then the market goes up 20%. Well, I'm going to get credited whatever my ceiling is. Let's call it 10%. It's going to get credited that 10%. So that 100,000 just turned into, let's say, hypothetically, turned into 110,000. Right. Meanwhile, I've got $50,000 over here earning me money on a fix and flip or a rental property, and now I'm going to pay back this loan. And what's really cool, it's called positive arbitrage. If you've ever traded cash, done currency trading, or arbitrage, the idea of, hey, I'm earning more interest over here than what my than what my loan is. And so you can have positive arbitrage. So again, let's use that example of 2009. And let's say you were credited 10%. So now I got a credit of 10% over here, and then I'm paying 4% over here or 5% over here. I just made a 5% positive arbitrage on my money. And so that's kind of the concept of it, is your money is always working for you. So my money's working for me over here in the life insurance, and it's also working over here in the real estate. And so when you do the analytics of it and you look at the rate of return that you might get, you're going to get a pretty good rate of return, hopefully, on your real estate investing. And then you're going to get credited over here in the good markets. And then in the bad years, you're not going to be losing money in your life. And so that's where it's being credited. On the whole life side, it has a consistent 3% growth rate every year, right? And then depending on the dividend that year, it may be 5, it may be 6, it may be 4, So that's the idea of the whole life. The reason I like the IUL, or the Index Universal Life Policy, is it has the potential for greater growth on an annual basis.
And when I borrow that $50,000, am I paying that percentage back to myself, or am I paying that back to a company? What's that?
Well, so you are paying that. So the loan is coming from, if you think of it this way, so whatever carrier it is, whatever life carrier, you're borrowing the money from them. They're utilizing your cash as collateral. So you're paying them back.
Okay.
And so that's how it works. Now, what you can also do as a real estate investor, let's say you can get a better interest rate than what you're going to pay on your life policy. Unlikely, but let's say you can. Well, you can always use that collateral to get a bank loan.
Right.
And they're like, oh, that's backed by a life policy. I mean, there's cash value there, and you can show them, and they will lend you money. The thing about utilizing a life policy is you make a phone call and say, hey, I want to borrow some of my money. And they're like, okay, how much do you need? And they'll send that over to you within 3 days. I mean, it gets wired into your account. So you don't have that waiting process that you have with the bank.
Okay, so I'm going to ask some hard questions here. What's the percentage if I borrow from the bank? What's a general percentage I get from that insurance company if I borrow against my UIL?
Right now, one of our primary carriers that we use, I believe they're at 4.1. That changes a lot. I believe they're at 4.1%.
And what's the life of that? How long do I get to keep?
Until you pay it back.
Okay, so good. There's no specific end time.
Yeah, so if you think about, if you've ever talked to, if you've ever had a conversation about setting up a life insurance policy that can be used during retirement, where you can pull out money, whenever you're borrowing the money, it's built into the plan that you will be borrowing that money, but the cash, the growth of the account will always be paying that interest. And then if you die, you're like, how do we pay off that loan? Well, the death benefit pays off the loan, and then the remainder goes to your family. Right. So that's how it works. And so go ahead.
I was going to say, what's a timeline of that? If I'm brand new getting started with a UIL, when could I start borrowing money? Or is that based on how much money I put into it to start with?
So one, it depends on how much money you put into it. Secondly, it depends on structure. And so when I sit down with somebody and we put a plan together, I will actually we'll talk through that. Like, how soon do you want this money? What is your plan? And then based on their plan, I'll structure a life policy that will fit within their needs.
Okay,
so it can be as quickly as a year, but usually you want to give it time to bake. And so 3 to 5 years is ideal. But I put a plan together for a guy. I basically said, hey, all right, because in addition to just writing the life policy, I'll actually come along and help them put a plan together on, hey, this is when you buy real estate. So whenever you get to this cash value, now it's time to be looking for another property, buy here. And then I went out 12 years and basically helped show him within 12 years he could be financially free, where it's all passive income from his investments, real estate investments, along with the life policy, drawing money from the life policy. So I can illustrate that. But yeah, usually 2-3 years is the time frame.
Okay, and so you're kind of doing a financial plan with someone, is that right? Are you in that area?
I help do a real estate. I help give them a framework of how to buy, and I kind of give them some structures of when you get to this cash, when you get to this cash value in your life policy, this is when it's time to buy. But then a part of that, I'll talk to them about, hey, do you have money set aside just in case you have air conditioners go out, or you need a new roof and you got to pay your deductible? We walk through that, and I'll put a plan saying, hey, is 15,000 the number? And if that's the case, we'll always leave $15,000 in the policy. But it all depends. Again, it's very tailored to the investor and what their plan is, what their finances are. Some people are coming to the table with $100,000. They're like, I have $100,000. I want to get involved in real estate, so I can create a plan. Other people are like, I have zero money, and how do I start? And so, we'll talk through that and create a plan accordingly. So.
And this is again, I like to ask weird questions, but what if it's borrowed money? What if somebody borrowed $50,000 and they want to put it in a term life, a UIL? Is that a stupid decision for them? Would they even think about doing that?
I would not recommend that.
Okay.
And the reason I wouldn't recommend that is there's a level of uncertainty in everything. I mean, I don't care what it is. We talked about entrepreneurship and the struggle of an entrepreneur. One of the struggles that an entrepreneur can get into is leveraging themselves too much.
Over leveraging.
And so I've done it, right? And there are a ton of success stories out there, right? Some of these guys that make great, have done exceedingly well in real estate.
Right.
They were leveraged to the hill. But what you never hear is there's one that was successful and there are 10 others that totally failed. Exactly. And had to start anew. And so I would caution people against that.
That's what I'm asking, because I know a lot of people are getting chunks of money from the government with all this COVID stuff.
Yeah.
They're trying to figure out how they can leverage that to do more things. But I'm like, that can get scary because you still have to pay that back. You're still paying interest. There's like too many flip-flops there.
Well, and the one thing that a lot of people with all of a sudden they're like, oh, I'm borrowing money from myself. You have to treat it, and the reason it's called the infinite banking system, you have to treat it like a bank. It's a separate entity, right? You can use a bank, and if you borrow money from the bank, guess what? You have to pay it back. Otherwise, they're foreclosing on that property. So you have to think of it, when you borrow your own money, you have to think of it as, I'm borrowing this money. I need to pay it back. Because if you don't pay it back, and that's the mistake a lot of people make, is they don't pay it back. And then they're like, well, this didn't perform the way you said it would. It's like, well, because you didn't pay it back. And so you have to treat it like a bank. This is an entity until the end, when you're just starting to draw passively. At that point, you don't have to pay it back. But when you're utilizing it as a bank, when you're utilizing it as a leverage tool, you have to treat it as this is going to be paid back. The great news is, push comes to shove, you don't necessarily have to pay it back, unlike a bank. It's just that now it won't work for you, and it may implode. And so that's where, that's where I think in everything that you do, whether it be investing personally in the stock market, whether it be real estate investing, it all has an element of risk. And so you just have to assess the risk. That's why, there are a ton of seminars. I think you educate people on how to invest in real estate. That's the reason people pay big money to do it, because they don't want to have that expensive life lesson. They would rather pay and avoid that life lesson.
Absolutely.
And
then, so give me a scenario. If I'm just getting started, I'm a brand new fix and flipper, a brand new wholesaler, whatever they're getting started in. When should they come talk to you? Should they do a few deals and have some money set aside, or should they just get started with you immediately and build that in the first 4 to 5 years?
Well, I would say get a hold of me. That way we can, let me sit down and let's talk about what your goals are. Let's look at that. Let's look at, how much money you're bringing to the table, and then we'll put a plan together, because I can help them put a plan together so that they can have a very specific idea of, when to buy, what can they afford, what can they not afford, and then we can structure it accordingly. So talking to me early is fine. You don't always have to come to me with a big chunk of money, because we can structure something elsewhere. And the other thing I love about life insurance, and let's be real, it is life insurance, so it is about the death benefit. That's why life insurance was created. But the great thing is, most people are getting involved in real estate, or most people are working. Why? Because they want to leave a legacy for their family. They want to be able to provide for their family. Well, life insurance provides that end game. So if something happens prematurely, they want to help their family be financially free. Well, what if something happens to you tomorrow? Do you have that protection in place? And so it does provide that peace of mind, because when you're an entrepreneur, you're taking risks. If you're married and you have a spouse that, you know, may or may not be supportive, right? But they want that, they want to know, hey, what if something happens to you? What are we going to do? And so having that in place is really important. And then that leverage piece is just a bonus. It's a way of, you know, basically having your money work for you in two different ways. So.
And again, I always like to ask the weird questions that people are afraid to ask. But if I'm putting, let's just pretend for a second, I'm putting $100 into this policy, whatever that number is per month. When will it start to gain interest, or is it only the amount that I put into that UIL?
So IUL, so Index Universal Life. So all life insurance policies, the way it works is the first money that goes in goes to pay expenses. So most policies are structured where the money goes in, you pay for the first year of expenses first. So first money, so if you're doing $100 a month, let's just use that example. For the first couple of months, you're just going to pay for that policy. And just kind of give you an inside look into life insurance. So first money in goes to pay the expenses. You know, it's kind of like your mortgage, right? When you when you get a 30-year mortgage, the reason the first 17 years you're paying more interest is because the bank wants theirs first. So same thing, right? Insurance wants to make sure that the expenses are covered. Then they say, okay, so expenses are paid for the first year. Now let's store up 12 months worth of premiums. So then that goes into a bucket that basically has a fixed amount. It's 3% growth is what that has. Then the money above and beyond that now goes into the indexing bucket where it can go up and down. And then so that's kind of the structure of it. So yeah, and then so you have those expenses and to pay for the death benefit. So as an example, if I have $1 million policy, I mean, I'm putting $500 in. $500 is not going to cash value. You are paying for some death benefit there. And so let's call it 450 or 400 or whatever the number is going over here. But one of the things about life insurance that is really unique is for the same reason that it works for you when you leverage for your business, on the back end, when you're pulling money out for retirement, you know, to help supplement your retirement, that money is constantly growing. Whereas in an IRA or things of that nature, when you're pulling money out, that money is just coming out. Whereas in a life policy, it just continues to grow. And so that's the reason it has longevity. So, yeah.
All right. So what if somebody wants to get in touch with you, they want to talk to you, what do you offer them? Do you offer like that, I'm a no pressure type salesperson?
Yes, absolutely. Absolutely. I mean, obviously I want your business and I believe in what I'm doing, but you know, I've talked to financial advisors or insurance people like myself where they're like, this is the only way. I don't believe that personally. I believe there are multiple ways to skin a cat. And I just think when it comes to people who have the mindset of an investor and an entrepreneur and being able to leverage money, I do think this is a great way of doing it because you're getting multiple benefits. So you're getting death benefit. There are some medical benefits in the life policies, and then you have that leverage. But best way to get a hold of me is, one, you can email me or just call me direct, but there is no pressure. There is no cost for me to talk to you. You know, some people do charge just to have a consult. That I'm a free consultation. So.
And when somebody comes to you, do they need to have like their balance sheet in hand? Do they need to spill their guts about their finances? What's the best way for them to prepare to talk to you? Because I don't want somebody to just come to you and just be like, oh, just help me get lots of money. That's a stupid mindset.
I'm really glad you brought that up. I'm really glad you brought that up because that could lead to 2 meetings versus just one.
Right, exactly.
So, I mean, ultimately, you don't have to disclose everything, but the more information I have, the better I can help plan. So, yeah, I would say, one, if they've got a business plan when it comes to real estate investing, you know, bring that with them, and then also just bring their budget, you know, their personal budget, or how are they going to live. That way we can analyze, what their disposable income is to see, you know, how much money I can put towards this to start working for them. So yeah, having that information, you know, personal budget and then business plan or even business budget would be really important. Because who knows, I might be able to save them, kind of maybe cut some bills and help them save some money. So, yeah.
Good. Yeah, I want to make sure because people hear something like infinite banking and they're just like, oh, I'm just going to go there and I'm going to make millions of dollars from using this thing and everything, but they don't have a concept of what comes first.
Right.
You've got to have some money. You got to put some money into it. It's not going to just, you put $100 in and you're going to have $1 million next year. That's not how it works.
So how it works with
a value building
anything.
situation. It's a long-term strategy, not a short-term strategy. So if you're just getting started in wholesaling and you don't have any money, you might not be ready to talk to Duncan yet.
Yeah.
If you've done a few flips and you got a $50,000 in your bank account and you're starting to get some consistency going in your business, that's when you probably need to start talking to somebody like Duncan, so you start setting that long-term strategy. I think that's the key. Is people think short-term. I'm going to take this house, I'm going to flip it, then I'm going to go find another house, I'm going to flip it. They bounce rather than having a long-term ultimate strategy. I love that you talked about having a business plan. I mean, if you don't have a business plan, start there. Start by building a business plan for your real estate business. Real estate investing is a business.
Yes,
Don't treat it like a hobby. Don't treat it like a side hustle. Treat it like a business, and you'll get long-term benefits out of it.
Yeah.
Then when you talk to somebody like Duncan, he can just take it to the next level. So you can leverage things, and like he said, you're going to leverage 100,000 for 150,000. You're still gaining interest on your 100,000, and you're able to leverage and bank for yourself. That's a cool concept. Some people do it with their IRAs. It's a different structure there. It's a different setup. And you'll have to talk to Duncan because I don't know all his numbers and everything. And they're going to change.
Yeah.
When COVID shifts, the insurance market's going to shift. It's just going to happen. That's just part of our life and everything. So, but you got to prepare and you got to head a direction.
I was going to say, you mentioned business plan. If people don't have a business plan, and they can be a little complex at times, but if they want a simple way, I use what's called the 135 GPS. I don't know if you're familiar with that, but basically you start off one goal, 3 priorities to support the goal, and then 5 steps per priority. And it is just a simple but really thorough way of setting up a business plan.
I'll tell you what, after this, you and I'll have another conversation, and we might just do a little mini session on doing a business plan. How's that sound?
That sounds great.
Why not? Okay, so we're going to stop this recording again. I want to take you.
You want me to give my contact info? I think I forgot to do that.
Go ahead and please give us that. It'll be on the
Okay, cool. All right, good.
As well, but please go ahead and tell us how to get in touch with you.
Yeah, so probably the best way to get a hold of me, email me at duncan@knowyouragent.com. You can call me 214-684-0918. That is my cell. If you're on Facebook, I'm @Advisor Duncan.
@Advisor Duncan. Perfect.
Yeah.
Great. Thanks for chatting with us, and we'll be back in a moment for another little session.
Thank you, Lyle. Appreciate it.